Got it. Excellent. Hello, my name is Charlie, and I'm going to be trying to answer this question today as to whether DSTs are creditable in the US as a foreign tax credit. In other words, are DSTs in lieu of income tax under Internal Revenue Code language, specifically Section 903. I'm going to try to break down all these terms. Hopefully, in theory, you don't need any real knowledge to understand what we'll be going through here, but hopefully I can define the terms and you can come out understanding a little bit about how foreign tax credits work and whether these DSTs that stand for digital service taxes that are being proposed and implemented in some cases in the European Union work out in terms of being taxable. Initially, I wanted to present a map of various countries, specifically in Europe, not just the European Union, but in Europe that are proposing and implementing digital services taxes. And these countries are a significant part of Western Europe, including France, Italy, Spain, Germany, and they've already implemented these services, these taxes on services. And there's a number of proposals, and there's other countries that have announced intentions. This is sourced. This is not my map. I got this from the Tax Foundation online, one of their publications, and it's very interesting to see these proposals coming up. And who knows, maybe even more countries might start adding in these new taxes. So it's very important to understand them and to see how they interact with other taxes within the international tax system. That'll help us understand the policy of these taxes, their goals, their ends, and the general purpose of them. So these are the maps. And a key question is, if you're an American company doing business in the European Union, in one of these European countries, are those taxes, these new DST taxes that we're calling them for short, are they taxable within the United States? I should say, are they creditable in the United States? They'll be taxable in this country. And often what happens, and I'll explain it a little bit in further detail in a slide or two, if you're taxed in another country, you can use that tax to offset a tax in the US. You can imagine, and in fact, some provinces of Prussia and interacting with each other in Germany in the 1800s ended up being subject to double taxation. And you can imagine if you do business in one country, in a neighboring country, and you end up getting like 20% tax here, 20% tax here. Let's say you're operating in, 5 different countries, you could be facing over 100% tax, and it would essentially make international commerce impossible. So in order to promote international commerce, double tax relief is important. But this isn't necessarily about the history of taxation. That's just to show that policy you could even see in the modern era. If you're in the US and you're a multinational company, you're doing business in like 20 different countries, and each country, let's say, is taxing you at 30%, and you're multiplying 30% on your worldwide income, it could really add up quickly, and it would effectively stop you from doing business abroad. So that's the policy of how foreign tax credits work. So the rule for a taxpayer who may claim a credit is essentially an elements test. It's checking the box. Not using that as a term of art. You just kind of go down the list. You're checking like, okay. So the first rule comes from this Treasury regulation. Only the person with the legal liability for a tax may claim an FTC, a foreign tax credit. I'm using that as shorthand for foreign tax credit, FTC. So if you're a person, which includes a corporation, if you have a legal liability in France to pay a tax, you can claim it. So that seems to make sense. To be creditable, the foreign levy must be a tax. So it's not a penalty. It's not a duty. That is a customs duty. You're not entering the country. It must be imposed by a foreign tax authority. So it can't be imposed by, like, let's say, the equivalent of the Environmental Protection Agency or something like that. It can't be imposed by another governmental agency. It has to be a tax authority. And it's not exchange for specific benefits. You're not doing this. You're making a deal with the government saying, okay, hey, I'll pay this if you do this, etc. You can think of multiple examples. It has to be a tax. So something that's kind of uniformly applied based on the person or corporate character doing business. in the country. It has to have the predominant nature of an income tax in the US sense. This essentially means a tax on net gain, not on gross profits. Gross profits are taxes that apply based on everything that you get. But remember, you could be in a loss position. So we're talking about net gain and stuff like that, not the gross profits, because you could have a huge gross profits, but after adding in, operating costs and like that and other expenses, you actually could be in a net loss position. So it has to be a net gain, and that's how an income tax functions in the U.S. sense. And the U.S. will, of course, interpret. Often these are fact-intensive studies to see how the other country is applying their tax. Another requirement is that it's not a soak-up tax. Sometimes countries, what they do, they say, okay, we understand this whole concept and policy of international double taxation and how it impedes commerce. So we'll only tax you if your home country is providing you a foreign tax credit. But if they're not, we're not going to tax you. In that case, the U.S. wouldn't provide the foreign tax credit as well. In certain situations, you could have a certain tax that isn't a normal income tax, but the US and that country have negotiated within a tax treaty to determine, okay, this isn't an income tax generally speaking, but we negotiate to agree that this will be creditable. An example is something called the German trade tax, which is a domestic tax that isn't necessarily entirely based on net gain principles that are found in the US Internal Revenue Code, but it's kind of divided into these three parts. It's business profits, business value, and business payroll. The tax treaty says only that first part of business profits are creditable based on the treaty. And again, this only applies because there's a treaty carve out. But for this treaty carve out, providing this provision, the tax in Germany would not be creditable in the United States. So sometimes you may have a tax, but it's not necessarily, doesn't meet all the requirements. The Internal Revenue Code gives you Section 903, which is this in lieu provision that states it's not imposed on net income basis, but it's a gross basis. So that character of income tax isn't imposed. So we're using the gross basis. And it has to be in substitution for and not in addition to an income tax. That is to say, let's say they decide not to have an income tax and they're just adding it and they're just putting it in there, they're substituting it for an income tax, then that will be creditable. You can understand the policy. If they're just adding it on top of the income tax, well, then that's like a different tax that's added. That is to say, in lieu of a normal income tax system, we'll give you a tax credit, but it's not in addition to the income tax system. Must meet the definition otherwise of a tax. So instead of gross basis, everything else needs to be met in terms of the character of the tax, because normal income tax in the US is on net income, not on gross basis. So so you can take that out, everything else needs to be met. And again, it must not be a soak-up tax. It is a tax. Credit is only available to offset that tax. If it's available in the other country, the US wouldn't allow that. So I think we have like a basic understanding. That was the checklist that we just went over for foreign tax credits. Let's talk about how DSTs work in Europe, in the European Union, in these European countries that are providing them, and anywhere else generally that's thinking about doing them. The OECD is even talking about them as well. A digital tax service purports to tax transactions that occur digitally through an expanded concept of nexus. That's some vague language, and I think it's intentionally vague to start off with. The OECD, Organization for Economic Cooperation and Development, came out with Action 1, and they had a similar definition, but these countries want to expand that definition. So for example, one good example, which I believe was the first example or one of the first examples, was the French DST tax to apply. And again, it's an element rule. That is to say, you kind of start just checking the list to see which elements are met for this tax to apply, the so-called tax, this DST tax. Company must make more than 750 million in gross profits. So that's a gross profits, not net income. It doesn't matter if you're in a loss position based on your operating costs or not. And two, company that provides the digital services, the company must be providing digital services. And the French government went into length to describe this. It defined digital services as services that require user participation, creating value, such as through advertising, sale of data, etc. It's also common to use this mining metaphor. You're not mining for coal, but you're sort of mining for data within specific countries, and instead of coal, you're getting extracting data. I think one of the main concerns is that this is maybe not the best all-encompassing definition. We kind of get the general idea of what type of companies they're trying to target with these digital services, but I think, as may come up in certain cases, they'll be able to say, all right, well, maybe these companies do that, but certain other companies aren't doing that, even though they are engaging in some level of advertising and extraction of data. So that's something else to consider, but that's sort of a technical argument that isn't necessarily related to tax. It's just like, are these falling within the umbrella of what the French government is defining as digital services? So let's go down the checklist of the foreign tax credit regime. So the first question is this a legal person with a legal liability? Yes, there is a legal liability. It's under the French code and it will be subject to persons. Is it a levy, a fine, a duty? Maybe, perhaps not. I would argue it probably isn't, but you could argue that it's closest to a duty. That's up in the air. And really, I don't see that as dispositive one way or another. It is imposed by a foreign tax authority, so that's a yes. Is it in exchange for a specific benefit? No, there's no benefit. They're applying it regardless. They're not giving you anything. They're just saying you do business here and you will be taxed. The character of the tax, this is the crux of the issue. Is it a net gain on income? No, the French government is only taxing gross profits. It doesn't matter if you're in a net operating loss or not. Therefore, probably won't meet this first rule of the foreign tax regime. And it's also not a soak-up tax. The French government is taxing regardless whether the US will credit or not. And they're frank about that and understand that that's the case to be. Moreover, there's no exception. As we had examined with the German trade tax, there is no exception. This is a brand new tax. This would require the United States and France or another country to negotiate a provision in the tax treaty, perhaps through a protocol. As of now, that does not exist. Now we go to that section 903 rule, which is this in lieu of in quotations. So it's not imposed on net income, it's imposed on gross basis. The French government imposes on gross basis, not the net income. So we actually meet this first prong test. There's no evidence, though, that this is in lieu of a normal tax. That is to say, it's not in substitute of normal income tax. You're just adding it on. And that's where you lose this test as well. There's been a lot of revenue rulings for various countries to examine. This is almost like an asset or gross test tax. And what's being tested is the asset or the gross test. So there's even revenue rulings probably indicating, maybe by analogy, not 100% certain, this would be would not be creditable in lieu of income. It probably doesn't meet the character of the tax as well. But we already lost on the other tests, so it really doesn't matter. And again, it's not a soak-up tax, but still that won't save it in terms of falling into this regime. So here's the conclusion. It's all up in the air, thus nothing is certain. One thing is for certain, there were US proposed regulations. Those were just proposed. They said they're highly subject to change in the preamble to the proposed regulations, so there's more to be seen. Policy-wise, the European Union countries want to get that fair share of income. This makes economic sense in the fall of the 2008 economic crisis and the COVID-19 pandemic. We'll see how it all pans out. And that may even affect the digital services as well. There's a question of whether BEPS Action 1, which proposed a lot of these new tax rules, will work. Arguably, they still maintain the same paradigm of residency and source taxation and the arm's length principle, which was developed by the economic scientists in the 1920s by the League of Nations, which have origins in the 1800s with the exercises that the Prussian Olzerein was working with that I had briefly just kind of hinted at earlier. A lot of these rules made sense that we have in our modern tax system in the 1920s. They made sense in the 1800s in manufacturing societies. There's a question of whether these rules actually even make sense in the 20th century, the latter part of the 20th century, or the earlier parts of the 21st century. We live in a highly digitized economy. We're not manufacturing staples and products and sending them abroad. There's a lot of international commerce that really could not have been predicted by economists in the 1920s or the 1800s. So there's something to be said that maybe this digital world will require something else, such as formulary apportionment or a single taxation theory. Formula apportionment actually exists within the United States. Transfer pricing exists within the United States, and has, because we've unified all our rules. I don't know what that would mean in an international context, because that would mean that states, that is to say countries, would have to divide up the pie with other countries, and that often requires quite a bit of negotiation. This concept of single taxation goes along with formulary apportionment, but they seem to be rather theoretical. They work within the economic union of the United States, but they may not, it would be difficult to negotiate them in an international context. There's been proposals to the United Nations, Article 12, that these would constitute services, and the US and OECD models might adopt them. However, it is unclear whether the UN model will be successful in promulgating these rules abroad into other countries. That is the end of my presentation. I appreciate your time. Feel free to ask me any questions that may come up.